Look, I'm going to tell you something that's going to sound insane at first. There's a fifth stage coming in the silver market that nobody's talking about. Not the analysts on CNBC, not the guys running billion-dollar funds, not even the people who lived through 1980 when silver hit $50 an ounce and then crashed so hard it took 40 years to recover. And here's the thing that should make you pay attention. We've already gone through stages 1 through 4. Right now in December 2025, we're sitting in the gap between stage 4 and stage 5. And if history has anything to teach us, stage 5 is going to make the Hunt Brothers squeeze look like a practice round. But before I explain what stage 5 looks like and why it's inevitable, you need to understand that silver isn't just some shiny metal that people make jewelry out of. Silver is the most manipulated, most misunderstood, and most explosive commodity on the planet. And the setup we're seeing right now has never existed before in human history. Let me walk you through the 4 stages we've already completed. Because if you don't understand how we got here, you won't believe what's coming next. Stage 1 started in '99. That's when silver was trading at $5 an ounce, $5. You could buy an ounce of silver for less than the cost of a sandwich, and everyone thought that was normal. Mining companies were going bankrupt. Nobody cared about precious metals. Gold was dead, silver was dead. But something started happening that year that changed everything. Central banks, which had been selling gold for 2 decades, suddenly stopped. The Bank of England had just dumped half their gold reserves at the absolute bottom, $2.75 an ounce, the worst trade in financial history. And that was the signal that the bottom was in. Silver started climbing slowly at first. 6, 7, nobody noticed. But the smart money was accumulating. By 2003, silver was at $5.50. Still cheap, still ignored, but the stage was set. Stage 2 hit in 2008. The financial crisis. Lehman Brothers collapsed. Bear Stearns vanished, AIG got bailed out, and the Federal Reserve did something that had never been done before. They printed $4 trillion to save the banking system. Silver went from $9 in November 2008 to $49 by April 2011, a 5 times move in 30 months. Everyone said it was a bubble. They said it was speculation. They said it was going to crash just like 1980, and they were right. It crashed hard. By 2015, silver was back to $14. The people who bought at the top lost 70% of their money. The mainstream media said silver was dead again. Another failed speculation. Another bubble that popped. But here's what they missed. Stage 2 wasn't about the price going up. Stage 2 is about proving that when central banks print money, real assets respond. When you create trillions of dollars out of nothing, people flee into things that can't be printed. Hence, silver is the most responsive metal on Earth. Stage 3 started in 2020, March 2020 to be specific. The world shut down. The economy stopped. And central banks around the world did something that made 2008 look like a warm-up. They printed $18 trillion in 2 years. The Fed printed $5 trillion alone. That's more than they printed in the entire decade after 2008. In 2 years, and it wasn't just the Fed, every major central bank on the planet opened the floodgates. Money printing on a scale that had never happened in human history. Silver responded exactly like it did in stage 2, except faster. It went from $12 in March 2020 to $30 by August 2020, a 2.5 times move in 5 months. But this time, something different happened. This time, retail investors got involved. Wall Street Bets, the Reddit group that made GameStop famous, turned their attention to silver. They started buying physical silver. They started buying SLV, the biggest silver ETF. They crashed the websites of every major bullion dealer in America. You couldn't buy silver anywhere. Premiums went to $10 at overspot. People were paying $40 for silver that was trading at $28 on paper. The squeeze was on and then it stopped. The price pulled back. Not all the way, but enough to shake people out. Enough to make it look like another failed attempt. By late 2022, silver was back to 18. The media said the squeeze failed. They said retail gave up. They said it was over. But stage 3 wasn't about the squeeze. Stage 3 was about something much bigger. It proved that retail investors could move the silver market. For the first time in history, regular people demonstrated they had enough collective buying power to break the paper pricing system. Stage 4 is happening right now. This is the stage nobody's talking about, but it's the most important one because stage 4 is about supply and demand fundamentals that cannot be manipulated away. Here are the facts. Global silver mine production peaked in 2016 at 900 million ounces. Right now, we're at 830 million ounces annually. Production is falling. Why? Because most silver comes as a byproduct of copper, lead, and zinc mining. When those metals aren't profitable to mine, you don't get the silver either, and the easy deposits are depleted. Meanwhile, demand is exploding. Industrial demand for silver is at all-time highs. Solar panels use silver and electric vehicles use silver. 5G infrastructure uses silver. Every electronic device you own has silver in it. Industrial demand alone is consuming 600 million ounces per year. Then you have investment demand. ETFs hold 700 million ounces. That's accumulated over 20 years, but it's still sitting in vaults, not available for industrial use. India and China are importing record amounts for jewelry and investment. Central banks in some countries are adding silver reserves. Do the math. 830 million ounces of production, 600 million ounces of industrial demand and investment demand on top of that. The market is in deficit. We're consuming more silver than we produce every single year for the last 5 years straight. And here's the kicker. Above ground stockpiles are depleting. The Conx, where silver futures trade, has 250 million ounces in registered inventory available for delivery. That sounds like a lot until you realize industrial demand alone would consume that in 5 months. Stage 4 is the setup. It's the stage where the fundamentals become impossible to ignore, where the paper market that's controlled silver prices for decades starts to crack, where the gap between paper silver and physical silver starts to widen into a chasm. We're in stage 4 right now. Silver is trading around $31. It's up from the 2020 lows, but it's nowhere near the 1980 high of $50, and it's nowhere near the 2011 high of $49. Everyone thinks silver is stuck. Everyone thinks it's just going to trade sideways forever. They're wrong, because stage 5 is coming, and stage 5 is going to be unlike anything we've ever seen. To understand what stage 5 looks like, you need to understand what happened in 1980. Because everyone compares silver squeezes to the Hunt brothers, but almost nobody actually knows the real story. And the differences between 1980 and today are what makes stage 5 inevitable. Nelson Bunker Hunt and William Herbert Hunt were Texas oil billionaires. They inherited a fortune from their father, H.L. Hunt, who was one of the richest men in America. And in the 1970s, they decided to buy silver, a lot of silver. Their reasoning was simple. Inflation was out of control. The dollar had just been disconnected from gold in 1971. Oil prices were spiking. They believed paper currencies were going to collapse, and precious metals were the only real money. So they started buying not just futures contracts, but physical silver, actual bars, delivered to warehouses in New York and Switzerland. By 1979, the Hunt brothers controlled 100 million ounces of physical silver. That was roughly half of all the silver available for delivery in the entire United States. The price responded. Silver was $6 an ounce in January 1979. By September, it hit 10. By December, it was 20. By January 1980, it peaked at $50. An 8 times move in 1 year. Everyone panicked. The Commodity Futures Trading Commission stepped in. The exchanges changed the rules. They implemented Silver Rule 7, which restricted new long positions. You could sell silver, but you couldn't buy. They increased margin requirements. They made it financially impossible for the Hunts to hold their position. And then they delivered the final blow. Volcker's Fed raised interest rates to 20%. Borrowing money became so expensive that leverage positions collapsed. The Hunts were forced to liquidate. Silver crashed from $50 to $10 in 8 weeks, the fastest commodity crash in history. The Hunts lost billions. They declared bankruptcy. And for the next 40 years, every time silver started to rise, people would say, "Remember the Hunt brothers?" And it's going to crash just like 1980. But here's what nobody tells you. The Hunt brothers squeeze was a targeted attack by 2 billionaires using leverage and futures contracts. They controlled the market through paper positions backed by physical delivery. And when the rules changed, they couldn't hold on. Stage 5 is going to be completely different because Stage 5 isn't 2 billionaires. Stage 5 is millions of retail investors, hundreds of institutional funds, industrial users scrambling for supply, and a physical shortage that can't be papered over. Let me show you the data that proves this. In 1980, global silver inventories were massive. Government stockpiles alone held billions of ounces. The U.S. strategic stockpile had been accumulating silver since World War II. India had enormous inventories. China had state reserves. When the Hunt brothers drove the price to $50, all of that inventory came to market. Governments sold. Individuals melted down silverware and jewelry. Supply flooded in and the squeeze broke. Today, those inventories don't exist. The U.S. strategic stockpile is empty, sold off in the 1990s and 2000s. India's imports over the last 20 years have exceeded exports. That silver's gone, melted into jewelry and religious items that will never come back to market. China went from a silver exporter to a massive importer. Their above-ground stocks are depleting just like everyone else's. In 1980, there was no industrial demand. Silver was used in photography and some electronics, but that was it. When the price spiked, industrial users could cut back or substitute other materials. Today, industrial demand is structural. You cannot make a solar panel without silver. You cannot make an EV without silver. 5G infrastructure requires silver. There is no substitute at scale. When the price spikes, industrial users have to keep buying or their entire supply chain shuts down. In 1980, there were no silver ETFs. If you wanted exposure to silver, you either bought physical or you traded futures. Today, SLV alone holds 500 million ounces. PSLV holds another 150 million. SPAT Physical Silver Trust, various European ETFs, they all hold physical silver in vaults. That's 700 million ounces that's been removed from the market and isn't coming back unless prices go dramatically higher. In 1980, retail investors didn't exist as a coordinated force. The Hunts were acting alone. To today, millions of retail investors are one Reddit post away from coordinated buying. We saw it in 2021. We're seeing it again now, and the next time it happens, there won't be enough physical silver to meet demand. In 1980, you could change the rules and break the squeeze because it was concentrated in 2 people. Today, the buying is distributed across millions of participants in dozens of countries. You can't change the rules on everyone simultaneously. You can't force millions of retail investors to sell. You can't shut down industrial demand. Stage 5 is the moment when the paper market breaks completely. When the gap between the price of silver on comics and the price of physical silver in your hand becomes so wide that the fiction can't be maintained anymore. Here's where it gets really interesting. Because the ETF data we have today gives us a window into what's happening in the physical silver market that nobody had in 1980. And what that data shows is that we're closer to stage 5 than anyone realizes. Let's start with SLV, the iShares Silver Trust. It's the biggest silver ETF in the world, over $14 billion in assets. It's supposed to hold physical silver in vaults in London. 1 share of SLV equals 1 ounce of silver minus fees. In March 2020, when silver crashed to $12, SLV held 480 million ounces. Then retail started buying. By February 2021, SLV held 670 million ounces. That's 190 million ounces of physical silver that had to be purchased and delivered to vaults in 11 months. Think about that number, 90 million ounces. That's 23% of annual global mine production purchased and delivered in less than a year. To put it in perspective, that's more silver than entire countries use in a decade. And here's the key. Those 190 million ounces came from somewhere. They came from existing inventories, from refiners, from above-ground stocks that were sitting in London vaults or Swiss banks. When SLV bought that silver, it removed it from the available supply permanently. Because here's the thing about ETFs, they don't sell. When people redeem shares, the ETF can deliver cash or physical. Almost always they deliver cash. The silver stays in the vault. So once silver goes into an ETF, it effectively leaves the market unless prices go dramatically higher and the ETF liquidates. Now look at what happened next. In late 2021, silver prices pulled back. SLV started declining in holdings. By late 2022, SLV was down to 550 million ounces. It lost 120 million ounces. Everyone said this proved the squeeze failed. People were selling, demand was dropping. Silver was dead again. But look at the other ETFs. PSLV, the Spratt Physical Silver Trust, was growing. It went from 110 million ounces in early 2021 to 150 million by late 2022. People weren't selling silver. They were moving from SLV to PSLV because they didn't trust SLV's storage or structure. Total ETF holdings worldwide didn't drop. They stayed elevated around 700 million ounces. The silver that came into ETFs in 2020 and 2021 didn't leave. It just moved around between different funds. And here's the critical insight. Every time there's a price spike, more silver flows into ETFs and never comes back out. In 2008, 2011, ETFs accumulated 400 million ounces. In 2020, 2021, they accumulated another 200 million. Every cycle, more silver gets locked up. Meanwhile, industrial demand keeps growing. In 2015, industrial demand was 480 million ounces. In 2020, it was 550 million. In 2024, it's 600 million. That's a 25% increase in less than a decade. Solar panel production alone is consuming 150 million ounces annually. Now, that's up from 50 million in 2015. Every solar panel installed removes silver from circulation permanently. You don't recycle solar panels. They sit on roofs for 25 years and then they go to landfills. That silver is gone. EVs are consuming another 60 million ounces annually. Every electric vehicle uses about an ounce of silver in its electrical systems. Global EV production is ramping from 10 million vehicles in 2022 to a projected 30 million by 2030. That's going from 10 million ounces to 30 million ounces of annual demand just from cars. 5G infrastructure, medical devices, water purification, electronics manufacturing. Every one of these sectors is growing, and every one of them requires silver. Add it all up, 600 million ounces of industrial demand, 700 million locked in ETFs, and mine production of 830 million ounces. The math doesn't work. We're running a deficit, and we're drawing down above ground stocks to make up the difference. The COMEX registered inventory tells you everything you need to know. In 2020, COMEX had 400 million ounces available for delivery. Today, it's 250 million. That's a 37% decline in 4 years. At current rates of depletion, COMEX will be empty by 2028. What happens when COMEX runs out of silver? What happens when industrial users can't get deliveries? What happens when ETF buying spikes and there's no available inventory to purchase? That's stage 5. Stage 5 isn't just a price spike. Stage 5 is a complete breakdown of the paper pricing system that's controlled silver for decades. And once it breaks, it doesn't come back. Here's how the silver market works. Right now, the price of silver is determined on COMEX through futures contracts. Traders buy and sell paper contracts representing 5,000 ounces of silver. Most of these contracts never result in physical delivery. They're settled in cash. The paper market is 100 times larger than the physical market. The system works fine as long as physical supply is abundant. If someone demands delivery, COMEX can source the silver from inventories and deliver it. The paper price and the physical price stay aligned. But what happens when physical supply gets tight? What happens when industrial users start demanding delivery because they can't source silver anywhere else? What happens when ETFs try to buy 200 million ounces and there's only 100 million available? The paper price and the physical price diverge. Suddenly, you can buy a paper contract for $35 an ounce. But if you want physical silver delivered to your door, you're paying $50 or $60 or whatever it takes to find someone willing to sell. We saw early signs of this in 2020 and 2021. Silver was trading at $25 on COMEX, but dealers were charging $35 for physical coins. A $10 premium, that's a 40% gap between paper and physical. That's not supposed to happen in a functioning market. The gap eventually closed, but only because industrial demand slowed during CO and some inventory came back to market. But next time, that inventory won't be there. Next time, the gap won't close. Stage 5 is when that gap becomes permanent. When physical silver trades at a massive premium to paper silver because there isn't enough physical to meet demand. And here's why it'll make 1980 look like a warm-up. In 1980, the problem was 2 billionaires manipulating the market. The solution was to change the rules and force them to liquidate. Problem solved. Market returns to normal. In stage 5, the problem is fundamental supply and demand. You can't change the rules to create more silver. You can't force industrial users to stop buying. You can't prevent retail investors in 50 different countries from purchasing whatever they can find. When stage 5 hits, governments are going to panic. They'll do what they always do. Blame speculators, implement price controls, restrict exports, nationalize mines. None of it will work because the shortage is real. Industrial users will start hoarding. If you're a solar panel manufacturer and you can't get silver, your entire production line shuts down. So you start buying 6 months of inventory instead of 1 month, then 12 months. Every industrial user does the same thing. And suddenly, the shortage gets worse. Retail investors will panic buy. The Reddit crowd, the preppers, the gold bugs, everyone who's been waiting for this will flood into the market. Dealer premiums will spike to $20, then $30, then $50 over spot. People will pay anything to get physical silver because they know it's not coming back. ETFs will scramble to source metal. SLV will have redemptions they can't meet. PSLV will have buying they can't fulfill. Funds will bid against each other for whatever inventory exists, driving prices vertical. And through all of this, COMEX will try to maintain the fiction that silver is trading at whatever the paper price says. But nobody will care because you can't eat a futures contract. You can't make a solar panel out of a paper promise. The paper market will break. And when it does, the real price discovery begins. So when does stage 5 happen? What's the timeline? And what does it actually look like when the system breaks? Here's what we know. We're in deficit. We've been in deficit for 5 years. Above ground inventories are depleting. COMEX registered inventory has dropped 37% since 2020. At current rates, we're looking at critically low inventory levels by late 2026 or early 2027. But that's assuming everything continues at current rates. The trigger for stage 5 isn't gradual depletion. The trigger is a sudden shock to supply or demand that breaks the system before it's ready. What could that shock be? There are several possibilities, and any one of them could light the fuse. First possibility, a major mine disruption. The top 10 silver mines in the world produce 200 million ounces annually. If one of those mines goes offline due to accident, political instability, or regulatory shutdown, that's 20 million ounces of supply that vanishes. In a tight market, that's enough to cause a scramble. Second possibility, industrial panic buying. If major solar manufacturers or EV producers get spooked about future supply, they'll start hoarding. One major company buying an extra 6 months of inventory means 50 million ounces comes off the market immediately. Other companies follow, and suddenly you have a supply crisis. Third possibility, another retail squeeze. Wall Street Bets or some other online community decides to coordinate buying again, but this time with more money and more conviction. In 2021, retail investors bought maybe 100 million ounces. Next time it could be 200 million or 300 million. COMEX doesn't have that much registered inventory anymore. Fourth possibility, geopolitical crisis. If tensions between major powers escalate, you'll see a flight to hard assets, silver, gold, commodities. Central banks might start accumulating silver the way they've been accumulating gold. That's hundreds of millions of ounces of new demand hitting a market that can't supply it. Fifth possibility, currency crisis. If confidence in the dollar or other major currencies collapses, precious metals will explode. Not gradually, overnight. In a currency crisis, people don't care about price. They care about getting out of paper and into something real. Any one of these triggers could hit tomorrow or next year or in 2027. We don't know the exact timing, but we know the setup is there. We know inventories are depleting. We know demand is growing. We know the system is fragile. When stage 5 hits, here's what the timeline looks like. Week 1, something triggers a spike. Maybe it's a mine closure. Maybe it's a Reddit post that goes viral. Maybe it's a geopolitical event. Silver jumps from $30 to $40 in a few days. Dealer premiums spike to $15 over spot. Week 2, industrial users start panic buying. They see the price spiking and inventories tightening, and they start securing supply. This adds another wave of demand. Silver hits $50, matching the 1980 high. Mainstream media starts covering it. Retail FOMO kicks in. Week 3, ETFs start having problems. SLV can't source enough metal to meet inflows. PSLV announces delays in delivering physical to new buyers. Conks registered inventory drops below 100 million ounces. Whispers start that COMEX might not be able to deliver on contracts. Week 4, the paper market breaks. The spread between paper and physical silver hits $30 per ounce. You can buy a futures contract at $60, but physical silver is trading at $90 in the dealer market. COMEX implements emergency measures. Maybe they force cash settlement. Maybe they halt trading. Either way, the fiction is exposed. Month 2, total chaos. Governments start intervening. Export restrictions, price controls, emergency measures. None of it works because the shortage is global. Silver hits $100, then $50. People who bought at $30 have made 5 times their money. People who waited are paying $200 for coins. Month 3, the peak. Silver hits some absurd number. Maybe 200, maybe 300, it doesn't matter. The point is, it overshoots massively because there's no inventory to bring to market. Everyone who wanted to sell already sold. Everyone holding is holding because they think it'll go higher. Then comes the crash, just like 1980. Because every spike ends in a crash. The weak hands who bought the top panic sell. Some inventory comes back to market. Prices drop 30%, then 40%. People who bought at $200 lose their shirts. But here's the critical difference. The post-stage 5 price doesn't go back to $30. It doesn't go back to $50 because the fundamental shortage hasn't been resolved. Mine production didn't increase. Industrial demand didn't disappear. ETF still holds 700 million ounces. So maybe silver crashes from $200 to $100. Maybe it settles at $80 or $90. But the new floor is dramatically higher than the old ceiling because Stage 5 permanently resets price discovery in the silver market. That's why Stage 5 is different from 1980. In 1980, silver crashed back to single digits because the shortage was artificial. It was created by the hunts. When they were forced out, the shortage disappeared. Stage 5 shortage is real. It's structural and it's not going away. The post-Stage 5 world is a world where silver trades at triple-digit prices because that's what it takes to balance supply and demand. The people who position before Stage 5 will make generational wealth. The people who wait will pay top dollar or miss it entirely. The people who think it can't happen because this time it'll be stopped, like 1980, don't understand that you can't stop a fundamental supply crisis. This isn't speculation. This isn't conspiracy theory. This is basic math. We're consuming more than we produce. Inventories are depleting. The gap is widening. Stage 5 is when the math catches up with the market. The only questions left are when does it start and will you be positioned before it does? Everything we've covered across these 5 parts leads to one unavoidable conclusion. Stage 5 isn't a possibility, it's a certainty. The only variable is timing. And if history has taught us anything, it's that these things happen faster than anyone expects and hit harder than anyone prepares for